We're joined now by Morgan Stanley's Adam Parker. He joins us from Morgan Stanley this morning. He's got one of the most bearish forecasts on the street among the big equity firms, and he's with us now to give us a read. Adam, I want to know, these 7 days of protests reaching a fevered pitch over this past weekend. Is this a kind of exogenous event that you model for, or were you taken by surprise?
Well, I wish I were smart enough to do that, to be honest with you, but no. We do think there are tail risks out there. I would not have said that this would be one of them, but we do think the market multiple is likely to contract. That's why we have a more balanced view of the market, not a very bullish one. It's because we think the market multiple will come lower with tail risks, this being one example, but there are many others, whether it's emerging Asian inflation or European sovereign debt or U.S. debt ceiling. There's a number of things out there we think could weigh on the market multiple.
But with an event like this, it sounds like you're keeping it in isolation. There's worry, though, of contagion. So how do you hedge your portfolio?
Well, our biggest overweight is energy. We think estimate achievability is above average for energy companies, and obviously this is going to help out the call in the near term. And I think that's one way. I think you can also get a bit more defensive in your portfolio. Companies in healthcare services, for example, may be a good bet in this kind of market.
Well, you like healthcare because it's cheap.
I think the estimates are more achievable than they are in other parts of the market, maybe even in staples, like as an example of another defensive sector. You have more achievable estimates, compelling valuation, and probably a reasonable chance for capital deployment, and that's part of our reason we're overweight healthcare as well. So
are you at a minimum rebalancing? What are you advising people this morning, given the hit that we took back on Friday?
Well, it really depends on investors and what their discipline is. We do think you want to be more mid to late cycle and more defensive in your sector positioning. That's consistent with the view that the market's near fair value today. Clearly, you don't want to have a high beta exposure when fear is rising.
Well, this morning, we're watching tech very closely because this breaking news out of Intel with, halting trading due to this chip defect. But tech stocks more broadly, we had some of the biggest earnings beats in this sector. Are you still feeling that there's room to run?
I think it really depends on the business. We do think within the offensive side of the barbell, we do like technology more than industrials, for example. We think that tech generally has better estimate achievability and more compelling valuation. So we do think there's room to run on specific ideas within tech.
Do you want to be specific with us on that?
Well, generally we're preferring services, software, and things that have better pricing environment. We're a little more cautious about businesses like semiconductors or PC hardware where pricing may not be as strong.
Mm-hmm. I'm looking at the quality versus junk debate note that your office sent over to me. When we're talking about hedging opportunities, what are some of the recommendations you're making?
Well, generally, when you get more risk averse, you want to skew your portfolio more toward a higher quality type of portfolio, and that's been our recommendation, to be more in the moderate to high quality zone, because we do think risk aversion will rise as this year grows. And I think this is an isolated event, but I do think that you can see more events like this, and that sort of argues for a quality biased portfolio.
So you originally forecast 2011 we're going to end at 1238 on the S&P. Are you sticking with that?
Well, sure, yeah. We just launched that a few weeks ago. Nothing about the earnings landscape or the multiple would change within a few weeks to make us alter that view. And I think the general view is it's a little bit like 2005, where you're the third year of a recovery. Earnings grow. We have 10% earnings growth this year, which is above the long-term average for the market, and certainly wouldn't make me bearish on the earnings. Mm-hmm. But I do think that, like in 05, you could get the market multiple contracting and offsetting a lot of that earnings growth, and that's really the tenor of the call.
I want to ask just why you're right now market weight in financials. A lot of people see opportunity given the dividends that are expected to be paid out. Why aren't you seeing more conviction there?
Well, I do think it's a place where alpha generators have to spend time. There's a lot of company-specific risks, and in fact, I'm going to address this at Morgan Stanley's financials conference tomorrow in New York. But to me, the pros and cons are pretty balanced. You're balancing the fact that these stocks usually work when the ROEs expand, and it's hard to create a near-term bull case for that, with the fact that the valuation is compelling and that the potential specter for capital deployment is a positive. So I see it as pretty fairly balanced right now. We're a little bit more constructive in some of the banks than we are in other parts of the sector.
Yeah, and you're underweight consumer and consumer discretionary. Talk to me about the intersection of that, because the retail investor, if you're feeling really concerned about their health, you've got to be concerned about their exposure in the financial space as well.
I mean, I think it's true. Historically, financials and consumer discretionary stocks were highly correlated. We're underweight consumer discretionary for a number of reasons, one of which is we see some of the margin headwinds as really growing. You know, food could be one possibility, and a number of our analysts here at Morgan Stanley have talked about margin pressures, whether it's in food retailing, select restaurants, apparel. And I think the market's telling you with these early cycle consumer stocks that maybe some of the rally could be over. You saw some of them roll over, even the mid-tier department stores earlier this year. So I think that I feel pretty good about being cautious about much of the consumer discretionary space where the stocks have rallied and they're embedding a lot of optimism in my mind.
Now, I've spoken to some of your colleagues at Morgan Stanley who are forecasting, more blockages on food exports because of food inflation and just how hard it is in a lot of developing countries to pay for food to put on the table. So what's the trade-off of that? I mean, what are you seeing out there beyond oil as a commodity?
Yeah, I think it's a great question. I think you're right. Food's probably as much the battle as it is energy. My sense is you really have to pay attention to pricing power. A company that can't pass on pricing, whether it's select consumer staples or household products or food, restaurants, retailers, I think they're going to have difficulty passing on the pricing to the end consumer. I think you do want to be more cautious about companies in those sectors. Individual names have pricing power, and then I think you could probably pair trade long the companies with benign pricing environments and short those with more onerous. And that's how we're formulating our portfolio, and we actually have baskets that folks are trading on our desk to get at that pricing power theme.
So in that pair trade, you would go more towards what? Companies that cater more to that middle class versus lower income consumer?
It's a little bit hard to get at that level because there could be some companies that are very high end that have pricing power and some that aren't. It really is about the ability to pass on the pricing. I think restaurants are a good example. Some of them have more elasticity to their products than others. But I generally would say you want to be cautious where the consumer needs to fit more of the bill going forward.
All right, Adam Parker, Chief U.S. Equity Strategist at Morgan Stanley. Thanks for joining us today.
Good to talk to you again.
Good to talk with you.